Three, two, one, go. All right, guys. So, welcome to lesson six of our higher time frame analysis. And this is Gene here. And today we're going to cover money management in higher time frame analysis, which is fund trading. So, this series, why I decided to add a series to the course is mainly due to the guys who wanna trade for hedge funds, right? So those who wanna manage fund account or other people's money. So basically, this section of the course is to give you pointers and direction on what you need to do to effectively manage a trade and how you can do that without really, you know, having to take too much time trying to trade, take too much time trying to do analysis every single day or every single week, simply using higher time frame analysis and the concept that I teach on the higher time frame analysis. So let's say, for example, you as a trader come to the marketplace and you want to quickly scale. You feel you've studied the market for a while and you're fairly profitable. You've done your research, you've journaled your trades, and you're fairly profitable with your results so far in trading. So what you want to do is, I feel the easiest way or the quicker way to build your equity in trading or your capital in trading is to basically apply to manage fund accounts, right? So basically, when you're managing fund accounts, you have to pass a test, and once you pass that test, you get given funds to trade with, and then you get a certain commission from that account based on the time period that is agreed with the fund provider. So what I'm simply doing here is for those people who want to quickly build up your capital, the marketplace, how you need to go about managing fund account, because managing fund account is one of the very prevalent quick ways to quickly build up on capital. Because what you're doing right now, or what you're doing then, is to trade a larger capital. Basically, what you're doing is you're managing capital, and then in return for you managing capital and bringing a good return on that capital, you get paid a certain commission of your profits in that trade. So that way, okay, you can easily leverage other people's money to, basically start your own trading career properly and just basically launch yourself into massive success in the trading industry once you have enough capital to leverage on to build enough money for you to become self-sufficient via trading. So what I did with this section of the course was to list some kind of like guidelines. So you think of them like guidelines whereby you need to just follow just simple things you could easily follow and also apply them to manage fund accounts. So that way you're always profitable in the long run. Because what we're trying to do with this call is to teach profitability in the long run and then basically remove your mentality from the retail mindset mentality whereby you need to make profit quickly and you need to make profit now. So this call basically is to uh, show you guys how by trading less often you can easily build a very reputable return on your capital trading a fund account, and then you can basically leverage the fruits of your labor trading fund account. So with that being said, let's get down to the meat of today's trading. So what I did here is the first eight rules or guidelines, which think of it that way, on what you need to do or to follow, kind of like to manage a fund account. So the first one is account balance isn't really important. Okay, so trading less and having a steady percentage growth over a calendar year attracts investors. Okay, so what investors want to see is a person who can manage your funds, okay, without having to trade so much, expose himself to a lot of risk in the marketplace, and basically you reduce your exposure to risk in the marketplace by trading less. And once investors are able to see you're having a steady percentage growth, okay, over a long period of time, investors are more satisfied with seeing an individual, okay, managing an account that brings a steady percentage growth more than a person who trades often, takes a lot of wins, takes a lot of losses, and even though that person might bring more percentage in growth, right? But the growth rate is not really steady, right? And investors will lose more trust in the person because what that would signal to the investors is that you're basically gambling with your money because you're trading every single time. You're getting yourself into a lot of losses. You're getting yourself, even though you're getting yourself into wins also, and you're having higher percentage growth, but the predictability of your percentage growth is unstable. It's not something that they feel can be sustained, right? Because you can't really predict where the account would end by the end of the year, which is what investors like to see. So investors like to see traders who don't really expose themselves to risk in the marketplace, but at the same time yield a steady percentage growth on an account. So the goal is 18 to 25% a year. So don't think when you're managing for an account, you need to make 100% a year, you need to make 120% a year, you need to make 5% a year. 18 to 25% a year is the industry standard. That is the standard expected of foreign traders to bring back an ROI of 18 to 25% of that capital each year. Now you could go for higher percentages, you could say 30 or 40. But what I'm saying is be okay with this. Be okay with 18 to 25% growth a year because investors, right, would like to see a trader who knows what he's doing by trading the market less often, and then they're guaranteed of a steady percentage each single year. Okay, so number two of our guideline is you're not required to use majority of the equity. Okay, you don't need to use every dollar of capital to trade profitably. So what I'm basically saying is your risk exposure in the marketplace, because with each trade you place, there's always a risk that you could lose that trade. There's always a probability that you could lose your money on that trade. So what you need to do to curb that risk, okay, is for you to reduce, okay, the equity you want to use to trade by taking only a certain percentage of that equity to trade the market. So what that simply means is this is where we get to the third part of the guideline, which is you limit your allocation to only 30% of equity. Okay, so that means, for example, right, if you, let's say you get funded with a 100K account balance, right? So you have $100,000 to start trading. Okay, so what you want to do is you want to remove $30,000 and you're going to use that to trade. Okay, so that is 30% of the entire equity. That is what you want to use to trade. Okay, so now let's say, for example, your risk per trade is 1%. Okay, imagine a fund account. Rather than trading 1% of 100,000, you're going to trade 1% of 30,000 because now you're reducing your allocation or you're limiting your allocation on your equity to 30% for any trading you want to do. So that way, even if you're taking on trade, that very much reduces the risk exposure to the marketplace. Now the risk exposure to the marketplace is greatly reduced because now you're taking the 1% of a 30% equity to place trades. So if you're losing the 1% of a 30% equity, what does that mean? You're losing $3,000. 3,000, 30%, yeah. You're losing $3,000 per trade. Okay, so now compared to you, so 1% or 100. Okay, actually 10% would be $3,000. Forgive me. Okay, so if you're losing 1% of a $30,000 account, now you're losing $300. Compare that to using 1% of a $100,000 account, because then you will lose $1,000. So I can see the difference, right? And then by using your risk to reward, you can easily compound your account. Okay, so number four, you determine maximum risk exposure on a percentage basis. You always want to treat the account professionally. Treat the account on a basis of percentages. What is going to be my return on investment if I take this trade? What is going to be the potential loss if I take a trade? What percentage of the account would be removed if I take a loss on this trade? What percentage of the account would be gained if I take a win on this trade? Okay, what is my risk to reward? How much am I willing to risk for a gain? What would I gain if I'm risking this? Is it worth it? How many percentages? So this is all you need to do. Then by the time you're taking each trade on a percentage basis, you can easily compute your monthly ROI, which will then help you forecast your yearly ROI. So if you're having a steady monthly return on investment, now let's say for example, every single month you're bringing in about 5%, okay, 3 to 5% on your equity, you know that by the 10th month, you're bringing in 30 to 50% of your equity. Okay? By the 10th month, you're bringing 30 to 50% of your equity. This is the way professionals handle fund account. And this is also the way you want to think when you're handling fund account. You don't want to use just trade every single setup that comes in the marketplace. You want to trade every 5 minute time frame. In trading fund account, what the type of trading you use is position trading and swing trading. So you want to either position trade or you want to swing trade. That way you're exposing yourself to less risk in the marketplace because you're taking lesser setups, but setups that could pay you potentially more in pips. And I'm also going to teach you guys ways to scale in and out of positions when trading fund account. Because now what you want to do is you want to do the least work possible to make money. You're doing the least work possible and you're making the most money. Because this is what most hedge fund traders do. This is what I myself do. Per month, I could take about 1 to 2 trades. 1 to 2 trades, and I'm done for that month. And then at the end of the month, I'm getting about 5% to 7% return on investment for that month without me not really having to do much. Okay, this is the kind of level you want to get to, whereby you're not really doing much, but you know there's a return on investment coming every single month. You're taking 1 to 3 trades, or 1 to 2 trades, not even 3 trades, right? You're taking 1 to 2 trades, good swing setups, right? And you know that this is the steady percentage coming on the account every single month. This is the way I handle my account, and this is some of the guidelines I'm giving to you guys as a way you should go by handling fund accounts. Because let me give you a little backstory. Okay, so I've been handling fund accounts for about 2 years now, and I initially started when I hit 5 figures in trading. So I wanted to quickly compound, and I had a fund account granted to me. And then what actually happened was I was very, very good at trading, right? Everything was all good. I was making a lot of pips trading my own account. But then when I went to hedge fund account, I was finding out that was my percentage growth was so zigzag. I mean, it was so haphazard. This week I could make 5%. Sorry, this month I could make 5%. The next month I'm making a negative 2%. Upper month I'm making 20%. The fourth month I'm making negative 10%. Because I was taking on every trade. I was trying to trade the account with the retail mindset. And guess what? In the 6th month, I got kicked out of the trading account. I got the account collected from me. I was unable to manage the funds anymore because my growth rate was very, very off the charts. I was trading the account with a retail mindset. I was always trying to take every single day trade, trying to day trade, trying to scalp, trying to swing trade. So I was doing all different strategies, trying to handle that fund account until I learned all these principles. So what these principles actually did was it made everything easier for me, and it also made things simpler for me. Because now what I do is I go into the market, I set myself up for a swing trade setup. Oftentimes, even in a month, I might not find any, really, really good swing setup, and that's okay. That's fine. Because what you're trying to do is you're trying to expose yourself to as less risk in the market as possible. At the same time, trying to double down on moves that really, really pay in the market. Because oftentimes, 4 months out of the year, you're going to get really, really good swing moves that pay a lot of pips. And when those pips pay, it really, really compounds the account massively. Okay, so what you want to do is you want to trade as less as possible. You want to look for only position trading setups and swing trading setups using all the tools and all the concepts I taught in the higher time frame analysis. And you want to set yourself up for success by bringing in the not setting too high expectations on that account. 18 to 25% every single year is okay. It is good. That is the standard. If you're gunning for 30% a year, that is fantastic. That is excellent. Because this is what the average most people bring a year on fund accounts is 18 to 25% ROI every single year. So what you want to do is you want to trade as less as possible. You want to expose yourself to the risk, to the least risk in the marketplace, but you want to really, really double down on trades that pay every single day. So this is where patience comes into play. Okay, so number five, ideally you set 1% of that 30% you're allocating for trading as the most risk per trade. Okay, so this is where you're using a really, really good risk management. So now let's say, for example, you're averaging 2 trades per month, right? And you're taking a 1% risk on 2 trades a month. Okay, 2 winning trades a month. You're averaging 2 winning trades a month. I'm talking about good swing setups now, and then your leverage or your risk on those trades are 1%. Okay, you're risking 1% on each trade. So now, if you're using a very good risk reward of 1 to 3, right, that means at the end of the month you're getting 6%. If you do that for 10 months, that is 60% on that account. You're getting a 60% ROI on that account. So now let's say, for example, you get funded with a $100,000 account. Okay, by the time you're taking 1 to 2 trades every single month, you're risking only 1% on those trades, right? At the end of each month, you're getting 6%. Okay, at the end of the 10 months, right, you're getting 60%. At the end of 12 months, you're getting 72% ROI on your equity. Okay, 72% ROI on $30,000 is a lot. Okay, 72% on $30,000 is a lot. Because now that brings you to $21,600 at the end of the year. That is a 21% growth on your account, risking just 1%. That is something easily doable. You can do this every single month with no stress, minimum risk, and you're meeting the industry standard. At the same time, you're not really doing much, but you're getting yourself paid. Okay, then number 6, your target risk to reward should be 1 to 3. You don't want to look for a 1 to 1 setup, okay, because we're swing trading or position trading. You don't want to look for a 1 to 2 setup. You're looking for a risk to reward of 1 to 3. Okay, so you know for every 1% risk you're taking, you're getting a potential 3%. If you know you're taking for every 2% risk you're taking, you're getting a potential 6% because you're using a 1 to 3 risk reward. Because you want to use a minimum of 1 to 3. Risk is 1 to a ratio of 3 reward. Right, so number 7, low risk, more rewards permits low accuracy. So your RR, which is your risk to reward, is very, very, very important if you want to take trades, especially with higher time frame analysis. Using the concepts I taught with IPDA, with seasonal tendencies, okay, with reversals, major market reversals in the marketplace. By the time you blend all these concepts together and you're finding very, very good risk reward setups in the marketplace, you're risking 1. So oftentimes you get a 1 to 4, a 1 to 5 setup, even a 1 to 10 setup. With swing trading, you can easily get this kind of moves. But the thing is, you gotta be patient and sit on your hands to get those setups. Because swing trading is unlike day trading, right? It's not like day trading whereby you're taking trades every single day. Okay, in swing trading, you're taking trades less often. Okay, you're taking trades less often, but you're also making sure that your rewards or the payout on those trades is very, very huge. I don't know why this actually went off. Something's actually wrong with this. So let's see what went wrong. Right, pardon. Let me get this fixed. Okay, I think we're back. We are back. Something went wrong with the laptop. Kind of got disconnected to the Wi-Fi. So it's all good. All right. So number 8 now on our list is low risk freeze equity to take on more setups. So now, by the time you're using a 1% risk in the marketplace, you're potentially exposing yourself to be able to take on more setups in the marketplace because now you have more margin to take on more trades and trades that could potentially pan out in the marketplace. So you know, now I teach. Oftentimes, I like to emphasize concepts used in swing trading, where we talk about carry trades. So for those of you guys who want to learn more about carry trades as a specific concept for trading swing trade setups or position trading setups, especially for fund accounts, reference the fundamental section of this course where I talk about dollar smart theory and carry trades. Okay, so oftentimes utilizing interest rate differentials can offer really, really, really good returns on trades. Okay, so you could use that concept to take on more trades because now you're taking only 1% of 30% equity per trade. So that is potentially freeing you up with more margin to take on more setups as your rules or as your concept permits you to do. Okay? All right, so now we go to the next slide where we talk about money management expectations. All right, so what we're simply talking about is what should your expectations be when you're trading fund accounts? What do you want to expect? What is something realistic that you can achieve? Okay, because remember in the marketplace, what we're dealing with is probabilities. There's no certainty, there's no surety in the marketplace. The only thing that we deal with is probabilities. Okay, and as much as possible, we always want to try to be realistic when taking trades in the market. So what we want to do, number one, is to focus on a handsome annual percentage return. Okay, often 18 to 25% is the industry standard. So 18 to 25% ROI on your fund account is the industry standard. That is what you want to aim for. That is something easily achievable. That is something you could easily do whilst exposing yourself to the least risk in the market as possible. Number two, you want to remember few long-term setups form annually. So do not expect that you're going to take 10 trades every single month. You're going to take 5 trades every single month. Or you're even going to take a trade a month. Oftentimes it could happen whereby there's no setup for a month, even 2 months. And you need to learn to get comfortable with that because what you're doing is you're swing trading, okay, or you're position trading. You want to do the less work and get the most pay. Okay, so remember that you need to be very, very patient for the right setup to come to you, the right swing setup to come to you, that you can ride the heels of, you can ride the coattails of the central banks of that move. And really, really get very, very good, handsome returns of those moves that you were patient for. Okay, so number three, you need to learn how to allow short-term drawdown in profits. So do not be quick to move your profits too quickly. Okay, do not be quick to move profits to break even too quickly. Okay, learn to be comfortable with being in drawdown. Don't look for sniper entries on swing trading. On position trading or swing trading, you don't look for sniper entries. What you're looking for is a good entry with a very good risk to a very good reward. Not sniper entries, because those are not realistic for swing trading. Those are not realistic for position trading. Because what you're gonna be doing now is you'll be executing on the daily time frame, same as the hedge funds do, also the same as the banks do. Like I teach you on the higher time frame series or the higher time frame concept, the banks execute on the daily time frame, and this is also what you're gonna be doing. You're going to do the bulk of your trading around the monthly, the weekly, and the daily time frame. So you need to learn how to allow the trades pan out. Learn how to allow the trades uh, execute themselves or play out. Okay, so do not be too quick to distress your analysis. Do not be too quick to expect the market to make a sudden reversal because you saw a very let's say we're bullish and news came out the day before and you saw a very quick bearishness in the marketplace. Remember, you're trading on the daily time frame. So that very quick bearishness you saw on the 4-hour time frame or on your 1-hour time frame would really be insignificant when you check it on the daily time frame. Right. So number four, stop loss orders having a measure of ability in long-term trading. So you can't go around boasting, oh, I had a 10 pip stop loss, I had a 40 pip stop loss, or I had a 50 pip stop loss, because those are not realistic numbers. Those are things that are not realistic when you're trading position trading or when you're trading swing trading. You want to open yourself up and allow the market to flow in line with what you want to see the market do. Okay? Give yourself room to breathe. Give your trades room to breathe. Okay? 100 pips is realistic. That is not too far fetched. 200 pips is also realistic. That is not too far fetched because what you're looking for, your potential pip page in terms of reward could be 400 pips, 600 pips, sometimes 800 pips because you're trading position trading or you're trading swing trading. And swing trading pays high number of pips due simply to the duration of the trades. Right, so number five, 200 pips risk for 600 pips is still a 1 to 3 risk to reward. If you're risking 200 pips to potentially gain 600 pips, that is still a good setup. Because your risk now on that trade is 200 pips for a reward of 600 pips, which would be a 1 to 3 ratio. Remember, you're taking a swing setup or a position trade setup, so do not be too judgmental about the size of your stop loss because you're executing on the daily time frames. When trading on higher time frame, resist the impulse to trail stop losses too quickly. Okay, same as what I talked about in number three. When you're taking trades in position trading or in swing trading, you don't want to trail your stop losses too quickly. You don't want to be too quick to move the market once the market goes 80 pips in your favor or once the market goes 100 pips in your favor. The market needs to get to at least 50% of the range you expect to take profits at before you move to break even. The market needs to get halfway to your profit target objective before you can move even. So make sure you're taking that note down. All right. So, um, of course, position trading requires a great deal of patience. Okay. And number seven, learn to exit at logical targets and re-enter at later times. So before you take a trade, you need to have a plan of exit. When the market does this, I will collapse this trade, or when I see this happen, I will close the trade at this point, or should the market get to this zone, I'm going to take off some profits, I'm going to do this. So before you take any trade on the fund account, have a plan of action. Should the trade go against you, have a rule or a guideline that you could basically follow to basically take precautions to prevent deeper losses. If the market goes in your favor, have a rule where you can easily follow to secure profits. So the market does not reverse against you and you basically get stopped at break even or even potentially a loss. Okay, so you need to learn how to exit at logical targets and re-enter at a later time. If price hasn't got into your profit target objective yet, you can also find re-entries in line with what you expect price to do. Number eight, long-term goal isn't to get rich quick, but to get rich steady. Remember what I keep saying during this section is you want to do the least work as possible and make the most money, because that is what the goal of fund management is all about. Doing the least work to make the most money. Those who manage fund account, the successful fund traders, don't really do much. That's why you see them go on vacation every time, because you're not really doing much. You're not really trading every single week. You're only looking for the best setups to take trades on. Okay, so the more times you take a trade with other people's money, the more you expose them to risk. This is why I explain and I'm telling you, or I'm emphasizing, that you need to take less trades. Okay, focus on paying yourself, focus on doing the least work. Take less trades, but look for very, very good setups that could pay you higher in pips. And remember, when you're managing money, you don't want to work hard, but work smart. Focus on realistic annual ROI, which is 20 to 30 percentage. Okay, so hopefully all these guidelines was helpful and beneficial to you, who and especially to those guys who want in the future manage fund account. Okay, for some reason, right? Because this were simple guidelines I applied to my trading, especially for fund trading. Okay, that really really helped me, and uh, and where I saw the most success with. So if you could simply follow these little rules and tweak that into your trading rule book, that could be of very very great benefit to those who want to trade position trading, or who also want to manage funds, or those who want to trade swing setups. So that being said, thank you guys for being a part of this call. I'll see you in the next section.